Okay, so let me quickly give you an recap whatever we have discussed yesterday. We have learned about the basics of private equity, types of private equities, types of investing, how a private equity firm invests in various typical types of asset classes, what are the role of general partner, and many related topic. So this is just an extension of yesterday's class. Here, what we are going to discuss is again about private equity funds, just in a few lines of private equity funds, followed by capital commitments and calls, distribution hierarchy, fund investments, fees and expenses, and at the end of the session there will be some challenging questions. So that assignment I'll be forwarding in WhatsApp group in only. So what you'll have to do, you'll have to fill up those assignments. There will be 23 questions based on today's session, and you'll have to answer all those questions. Okay, so let's move ahead. Now, I prepared the entire PPT for your reference so that you can relate. Otherwise, it's very difficult to communicate. Means if I keep on talking, and you can't see anything on the screen, sometimes it's very hard to mug up things. So, as we know, private equity fund invest in private companies. We have discussed a lot of time about this, which are not traded in an open market. This is also something quite known to us. They invest primarily in equity securities companies, which are intend to make initial public offerings of their share capital, may have different stages of entrepreneurship, startup or seed money stage, expansion phase, and mezzanine level. Now, you see these 3 points: startup and seed money, expansion phase, mezzanine finance, mezzanine level. You can relate yesterday's lesson, whatever we learned. That on startup phase, what are the private equity types? What are the types of private equity firms which are actually interested to invest in startup phase? That is venture capital. Expansion phase, growth funds, and mezzanine level, buyout. Okay, so a question could be asked in interview. Now, see, private equity funds are typically limited partnership. Obviously, these are LLP or limited liability company. It could be limited liability company as well, LLC, with a fixed term of 10 years. Mostly private equity firms are set up for 10 years. There could be an annual extension. So, question could be asked, if the private equity tenure is getting extended, could it be 10 years and 6 months? Or could it be directly extended for next 3 years? No, it will always be an extension of a year. Means an annual extension will happen. In even if it is at all looking for an extension. So at inception, an investor makes a commitment to the limited partnership, which is then drawn over the term of fund. So at the initial level, an investor commit some investment without knowing where this money is going to get invested and all that. We have discussed about blind pool. That is why it is called blind pool. A private equity fund may also invest in other private equity funds. This is also have been we have discussed in last session, yesterday's session, that fund of fund. As the private equity funds underlying investment are liquidated, the proceeds are not normally reinvested. Rather, the proceeds are distributed to partners in liquidation of their interest. So this is a basic fundamental difference between mutual fund and private equity fund. In mutual fund, in many cases, you would see that returns are getting reinvested. But in case of private equity, it's not the case. It will be diluted completely. Liquidation will happen, exit will take place, and limited partners will get back their return by way of appreciation of their invested capital. So if we move forward, the next one would be capital commitments. Yesterday, we came to know that you want an overall glimpse of capital commitment. Okay, so and calls. So I prepared these slides. It's just a summary of capital commitments and various type of calls. So here I have mentioned that capital commitments and capital calls are the methods used to find a private equity investment. Okay, every investor commits to investing a specified sum of money in the fund partnership over a specific period of time, a known factor. Second thing, the fund records this money as the limited partnerships capital commitment, LP's capital commitment. The sum of all commitments is equal to the size of the fund. 10 investors are there, 10 LPs are there. If you club all the capital commitments of those 10 investors, it is the size of the fund. Both the limited partners and the general partners must make capital commitments to participate in the fund. This is nothing new. Like general partners, how much is a it varies. This general partners contribution, it is 1% to 5% of the whole fund size, and the rest of the thing, if there is no debt financing, then the rest of the fund has to be funded by the limited partners. Investor in a private equity commit to certain total capital investment in the fund. Initially, investor may deposit a portion of their committed capital commitments with the fund, generally 10%, with future deposits being make over the life of the fund at the request of the fund's manager. Means initially 10% is being invested by the limited partners, and during the course of investing, during the life of the fund, the further 90% have been invested gradually. This is not always applicable. There are funds we have seen where 100% of capital has been invested, all capital commitments have been called, and 100% has been invested at a very initial level. So this formal request for capital are known as capital calls. Means when an GP is asking for capitals, it has to be a formal request by issuing mail, by writing letters and all. So this way amounts to be the capital call. Capital commitments generally are not recorded on a fund's book until they are received. Means capital commitments are not getting recorded on accrual basis. So here could be a big accounting catch. If a GP wants to raise 100 billion of dollar, so unless this capital is been received in funds books of accounts, means in funds bank accounts, it doesn't get recorded in funds books of accounts. Correct? It is purely cash basis, not an actual basis. So for due capital, due money, and due everything, how the journal entry would be, that we'll see in following slides. Record keeping for a private equity funds involves keeping track of each member's total commitment and contributed capital. So there could be a difference. You can very well understand that there could be a difference between commitment and contributed capital. Correct? Now, capital calls give rise to contribution to a fund, and these contributions are recorded to partners' contributed capital. See, we have a chapter. It's called Partners Capital Account. Partners Capital Accounting. Their whole session, one whole session I would conduct. Here you will understand in detail how does this capital calls are getting recorded. Here also we'll understand, but that would be at an advanced level. So here capital calls gives rise to contributions to a fund, and these contributions are recorded to partners contributed capital. So you can understand from accounting perspective, the The capital commitments would be recorded in funds books of accounts. At the same time, fund will be maintaining partners books of accounts on behalf of partners, LPs. So there also the subsequent entry has to be recorded. Correct. If capital is been received, so what would be the journal entry? On a layman basis, it would be cash account debit to capital account. This would be recorded in funds books of account. The subsequent amount, subsequent entry would be passed in LP's account as well. If I'm receiving a cash as a capital, so it is cash account debit to capital in my books of accounts. What would be the opposite entry? My capital would be your investment. If you are giving money, you are paying money to any particular securities or any particular fund or bank, wherever it could be, it should be termed as an investment. It should be recorded as an investment in your books. So in partners capital account, it will be, yeah, sorry. So in LP's account, it will be recorded as investment account debit to cash. Clear? The balance due on commitment, given the capital calls that have been made to the date, is referred to an unfunded commitment. Means if a particular LP is committing of a capital of 10 million as on date, if he has only paid 20% of that 10 million, that is 2 million, then balance amount, that is 8 million, would be termed as unfunded commitment. Question could be asked whether we are passing any journal entries for unfunded commitments and all. In coming slides, we'll see everything. See, you can take down this journal entry if a note is handy with you, notebook is handy with you, like capital call. Here, this is the amount is called for an investor with a commitment of $30 million. The following entry would be passed. The record entry would be like capital commitment receivable account debit to investor contributions account debit. And in partners unfunded commitment would be recorded as 20 lakhs, reduced to 20 lakhs. When the cash for the call is received, another entry would be passed. How? Cash account debit to capital commitments receivable account. So this entry is the due entry. See, we are following accrual concept of accounting. So first, we need to pass the due entry. This is something called booking entry. Okay. And this is something called closing entry. While we are passing the booking entry, first what we'll have to do, we'll have to pass the accrual entries. That is capital commitments receivable account. Something which is receivable is an asset in our books of accounts. So we are about to receive this amount. So asset is getting increased. If we follow the basic rules, golden rules of accounting, when asset has been increased, so it will be debited. So capital commitments receivable account debit to investor contributions, that is capital. See, normally we can write it as a capital account, but every industry, every different types of fund is having their own industry jargons. So these are actual basis ledger codes, ledger name, I would say. Ledger codes will be there for each and every type of ledger accounts. So these are the actual ledger name. This is how a journal entry has been passed in a private equity funds account. So unfunded is the balance amount, that is 20. And once the cash has been received, then opposite entry nullifying the open entry, that is our accrual entry, will have to pass. As because we are nullifying the opening entry, that is why it is called, I mean, open entry. That is why it is called closing entry, close entry closer. Cash account debit to capital commitment receivable account credit. Clear?
Toro, I have one doubt.
Yeah.
When we record the first entry, means due entry, I mean, actually we have to send capital call notice, right? At that time, we have to enter this entry, or at the
Yes.
end of the month.
No, no. First, we'll have to pass the capital call notice. We'll have to issue the capital call notice. Based on that, capital commitments will be made. I mean, contributions will be made.
Okay. First.
Once the contribution is made, then we will record. This due entry would be passed while passing the capital commitment notice. Okay. Once the receive entry cash is received, then the closing entry would be passed. Okay.
Okay.
For the unfunded amount, no need to pass the entry, no? For 20.
No, correct. This is was I was explaining
Right.
in last slide. For
Yeah.
unfunded amount, there is no actually no transaction is happening, right? This is
Yes.
just a notional thing. See, if you have guys have gone through any balance sheet of any normal company, you would find one line item called authorized capital. For authorized capital, we do not pass any accounting entry. Authorized capital is the capital which is ceiling limit. To that limit, this is the highest limit of capital that a company can raise. Okay, it is been mentioned for a normal trading or manufacturing company. Authorized capital amount is mentioned in its memorandum and article of association. In AOA also it is not mentioned. Mostly it is in mentioned in MOA, Memorandum of Association. Okay. So authorized capital means what? This is the highest amount of capital that the company can raise. Now it's just a limit that just is just a kind of resolution that a company is passing. No accounting entry, no transaction has taken place. Since there is no transaction, what is the need of any passing any accounting entry? The same concept you can apply here. Okay. So moving to the next one, private equity funds may
Uh,
admit new.
my question is that out of the authorized capital, we have suppose the authorized capital of this fund was 30 million, and out of that we have received 10 million, but 20 million we have not received because we have not made another capital call. So
Correct.
when we announce another capital call, then we will pass the entry for the due amount in that call.
Provided for entire 20 million we are passing the capital call.
No, but suppose the remaining 20 million, if we make two different capital calls for it,
Mm.
then for
Then it
every
has to be
capital,
support. It has to be supported by the amount.
okay. So if the second capital call is going to be for 10 million, then you will pass a due entry, and then when the partners actually give
Correct.
cash,
Correct.
we will pass the closing entry.
Absolutely. Okay. This is a simple concept. So shall we move further?
I had another question. Correct me if I'm wrong.
Yes, please.
Actually, in the previous slide, we had mentioned that capital commitment generally are not recorded on a fund book until they are received. Until they're received, and you said it is purely cash basis. So, is this capital commitment talking about the total commitment or the capital call part? Because in the second slide, the example you mentioned it's capital commitment receivable account debit. So I had
See,
a confusion.
yes, your doubt is correct. Absolutely correct. Now see, there is some layers. Okay, in day-to-day in practical fields, there is some layers. The moment this capital call notice is issued, this due entry has been passed. Okay, and after once the amount is received, this cash entry has been passed. But the thing which I have just mentioned here, I think here in the first slide, that unless this capital commitment is been received, capital calls gives rise Initial capital commitments generally are not recorded on funds book until they're received. Okay. Now, these capital commitments, this statement actually implies that unless there is an uh, issue notice has been issued. Now, the meaning of this, what is actually implies that once you are recording something in your books, if you are recording a due entry in your books, you cannot reverse it simply by stating and reason that commitment is not received. Okay. If you are recording a book, due entry in your books, it has to be supported by some evidence. Once it is evidenced that due notice has been issued, it means that capital will be received. Okay,
But there can be cases wherein the capital commitment is not met by the investor also. Right?
there could be cases, but it is not the case in normal phenomena. Okay, I'll tell you, these capital commitments generally not recorded means what you are trying to portray is the total, the $30 million. Obviously not. No capital commitments will be recorded in the books unless it is received, but due entry would be passed at the time of issuing the notice.
Okay.
Okay,
So, so due entry will be passed for every capital call, and then when the cash is received, it will be shown as uh, asset. Cash is received against receivable account.
correct. But here her question was, what is the connection between this line and the next slide? Here in this line, it has been mentioned that capital contribution generally are not recorded. Capital commitments are generally are not recorded on funds books until they are received. So it is purely cash basis. So what is the point of passing this due entry? This is accrual basis. Why should I pass this accrual basis commitment
But this accrual
entry?
entry is it has been posted. This entry has been posted because there was a capital call.
And how do you know there is a capital call? Because you have issued the letter. Even before, see, even before I'm taking her question, there cannot be any, you know, situation where a limited partner is not paying its capital even after issuing call notice. There will be a legal consequences. I'll tell you. So whatever negotiation has to be there, it has to be before issuing the call notice. Are you getting my point? Once the call notice is been issued, it means due entry has to be passed.
Okay. Okay.
Before issuing the call notice, call notice, you'll have to have a negotiation through a proper channel. It could be verbal communication, it could be written communication, or what. Means if you're issuing, it is because of some regulations. Private equity firms, yesterday we have been discussing that private equity firms, hedge funds, mutual funds, all are governed by separate, laws and relevant, acts in the domicile where it is registered. So as per the law of prevailing country, it, it is clearly mentioned, if you're issuing a call notice, that means you'll have to record a due entry. Means the capital you are issuing capital call notice means the capital would be, there in your books. Okay. So whatever negotiation will have to make, whether capital will be received, the notice will be honored or dishonored by the LP, all this discussion negotiation has to be done before issuing the notice.
So, if a notice is issued and then a due entry is passed, but
Yes,
but in reality, if a certain LP does not pay the amount which that
that
LP
is
is
what
supposed
i'm
to pay,
that is what I'm pointing out. There cannot be any such reality. If even if it is not paid up, In that case, this due entry would be clubbed with the next call notice.
Okay.
Okay. Say
And
for an example, 4 times a LP is supposed to invest his capital. First time he has given, second time failed. Third time it will be the second call and the third call together. If he is not obeying the, actually it is a binding between the GP and LP. It has to be supported by some legal document. A LP cannot simply disobey, dishonor this capital call notice. Understood? Please understand the point. Here it is mentioned that capital commitments generally are not recorded on funds books until they are received. Until they are received means until capital call notice is been issued. Capital call notice has been issued means it will be received. It has to be honored.
okay.
Otherwise, it will be consolidated with the next installment.
My further question is that if the LP dishonors the capital call, that dishonored amount will be included in the next capital call. But ultimately, if the LP does not pay what he has committed,
Hmm.
then only the fund will go for debt financing.
It's not the case in, you know, yesterday I think I have covered one part that if a particular J curve dry powder just have covered.
Actually, that
I'll
that
tell you that situation.
Mhm.
There are several situations during recession time that LPs has failed several capital commitments.
Mhm.
Okay, on a different term, on a more beneficial term, those commitments, those shares are being offered to other LPs. Okay, now
So
debt financing there could be, but there would be huge legal consequence. Now, if the your case, if the LP is declaring himself as an insolvent, there could be case insolvent. So in that case, the insolvency and bankruptcy code will be applicable. So there will be a huge legal consequences around that.
so debt financing will be considered only if the remaining LPs are not willing to pay up that amount.
That could be a, again that could be a situation.
Okay.
Debt
And
financing, no, you are actually confusing between two funds. You just want to, time the debt financing. At what time debt financing would arise? Is it like if the situation is like uh, the way you said mentioned that other LPs are not going to pay, not ready to pay, or at the beginning of the fund? It is completely depends on investment manager's discretion, how he is going to structure his financing. Your case is something different. This is accidental, it's an I would say contingency impact. It could be an termed as a contingency, incident to cover up any contingency. If there is no honor by any LP for this capital commitment, then only debt financing would take place. It is not the case. Their debt financing could take place at the very initial level as well. It is purely based on investment managers' discretion.
so
Getting my point?
yeah, yeah. So debt financing is basically a policy which is decided before the fund is raised.
Sometimes it could be before the fund is raised. Yes, it is. If the structure suggests so, then it is okay. Otherwise, if there is any contingency, debt financing could be, see, debt financing is just a tool, it's just a lever. Just try to understand like this. If something is very heavy, there is a heavy material. If you are capable enough to lift it up without using any lever, then you are free to do that, right? Otherwise, if you know that I'm not going to lift it up, I don't have that much of capacity, then you will certainly use that lever. Debt financing is nothing but a lever, a leverage. Are you getting my point? If there is any contingency event happens in future, to cover up that contingency, you can use debt financing. Otherwise, if it is your set policy that only 80% I would go for ownership, means from LPs I will take 80%, balance 5% will be given by GP, and 15% I will get it from as a loan. I'll borrow it from a financial institution or whatever it could be, or if any LP is coming as a debt provider. That's the thing. So what will happen, what he will do, it is purely based on investment manager decision, how he wants to do it. There is no set rule, I would say. Okay. Yes, no, very good.
Yeah, got it, got it.
Yes,
And if the fund is going to take debt financing as a policy, that will be mentioned in the LPA.
yes, obviously.
Okay.
So shall we move further? You guys want to take them this entry? These ledger codes are very much required. Otherwise, you can take a sniff as well. Okay. Just give me a moment. Okay. Let's move to the next slide. Private equity funds may admit new investor in closings that offer after the initial closing. Can anyone summarize this? Can anyone read out what's written here?
So this means that uh, after the first capital call, it is possible that for the second capital or third capital call, some new investors will be included in the fund.
But yesterday we have discussed one term, that is close-end fund, right? So again conflicting. If it is a
I
close-end
think
fund, no one is allowed to take an admission once the fund has started commenced after commencement date.
Actually, here sort of a completely new investor is coming for uh, for the uh, for the first cap. I mean that for the new capital commitments got. So that's why I mean that here the mention like admit new investors in closing that occur after the initial closing. So once the that old commitment calls will be the closed. So after that, I mean that for the next commitment call, so completely new investor is coming into this picture. What I understood.
Now, if you can just go through the second line, the new investor, say for an example, say 1/4/24, three LPs were there. Okay, the next installment date was 1/7/24. So these three investor wants to continue, but one more investor wants to invest. Now, at the end of the year, if it is the next installment would be 1/9/24, I think 10, and it would be the last one would be 1/1/25. So these three investor has started his investment journey with this firm from the very beginning. So whatever return will be paid earned by the firm, these three investors are entitled to get whole enjoy the whole return throughout the year, but another investor, being A, is entering the fund on 1st July. So he will be entitled to enjoy the return for next 3 quarters, for the rest of the year. But there is a thing called make-up interest. Make-up interest. As because this new investor is joining the fund little late, so he has to compensate in terms of their capital commitments. He has to pay extra, he has to bear all the management fees from the date of original closing to the date the investor are admitted to the fund, everything. He has to pay retrospectively. Okay. That is something called makeup interest. By the name it suggests you can understand makeup. He
So
is joining
earlier the makeup interest which was divided by 3, that same amount will be divided by 4, and the adjusted amount will be paid by the fourth investor in the second capital call.
you are almost right. But the thing is that existing three investors are not supposed to pay any additional interest because they are continuing from the very beginning. They started from the very beginning. Okay. To match up the requirement of initial first quarter, the newly appointed, newly joined investor has to pay something extra in proportion of the other three old investor. It is just simple. A batch has been started in August. If somebody has joined the batch in the middle, then he has to put some extra effort to match up. This is what called make up interest.
So, Saurabh, if I'm not wrong, so you want to say like one additional investor is going to join the between of the contract. You mean to
In the
say?
middle of the contract,
Yeah, yeah, yeah. Middle
additional
of the contract.
in the middle of the contract, and
Hmm.
whatever extra money towards management fees and everything
So he wants
he
to
will
say,
be bringing, he will be
yeah, yeah.
bringing that amount will be divided amongst existing investors.
Oh, okay, okay. Now got it.
But my question is that if the fund started with 3 LPs and a fourth LP is coming in, then does it mean that this fund is not a closed-end fund?
Obviously,
So it is an open-ended fund.
yes.
Okay.
And here in third line I've mentioned the makeup interest is typically allocated specifically to the old investors. Mr. A, new investor, whatever makeup interest he has to pay, that much of amount has to be divided amongst existing investors for makeup portion.
And
If
once this,
everyone, if everyone, let me break it down, has invested 10 million, Mr. A would bring 12 million. This difference of 2 million would be divided. Let's make it 13 million. 3 million would be divided amongst these three LPs. So initially their commitments was 10 million. Now without paying a single bucks, additional 1 million would be added to their individual commitments. Actually, these old existing investors are allowing Mr. A to be an investor in the middle of the fund, and that is for this. In hedge fund, it is called levy. In private equity, the term is called makeup interest. Clear?
and yeah, and after the fourth LP joins, then the percent partnership percentage will be recalculated. Is that so? Like earlier, there were 3 LPs, so partnership interest percentage of profit was 33% for each LP.
Now it would
Now,
be 25%.
yeah, yeah.
As because their interest, existing investors' interest are getting compromised, they need something extra from the new investor. Getting it?
And
Right.
Saurabh, one more doubt. If fourth investor, if fourth LP will come, so again all the contracts, all the agreements will new amendment. I mean that again they will prepare again the agreement for the new agreement.
Yes, but there should be an existing clause. Amendment clause should be there.
Yeah.
Once agreement is been formed at a very initial level, it
Mhm.
has to be mentioned there that this makeup interest would be charged for any new joinees, or this there could be some amendment as well. That clause has to be mentioned at the very beginning. That is why it is an open end fund.
Okay. Sure. Sure.
Yes, someone was asking something.
Yes, I had one more thing. So is
Yes,
this similar to the equalization concept? So for
equalization levy.
example, yeah,
Equalization levy.
yeah. So for example, these three guys have invested 10 million at the
Hmm.
beginning of the year, and now the value of the investment say is increased to 15
Certain.
million, for
Yes.
example.
Yeah.
Okay, so now that 15 million, so 5 million is the profit which would have been distributed between these three LPs. But
Instead,
now there's an
this time it will
additional
be divided by four.
by yes, right. So that is why the new investor has to, pay up something called as lake up interest so that he can also be part of the gain which was already made. Is my understanding correct?
Absolutely clear.
Oh, thank you.
For private equity, it is called make-up interest. For hedge fund, it is called equalization levy. Okay.
Yeah. Thank you.
So, as I mentioned here, in return for this consideration, the new investor will be treated as through they were in the funds from the beginning on the original closing date. And all prior income, expenses, gains, and losses must be reallocated to include the new investor. Okay. There will be a reconciliation. Everything has to be reallocated as per the new proportion. Clear? What are the things we'll have to reconcile and recalculate? That is prior income, prior expenses, prior gains and loss. These three things. Okay. So moving to the next one. Most of the fund use investors' capital commitments to determine allocations and distributions rather than capital account balance. Okay. The capital commitments here is a very crucial point. Capital account balance could be different than capital commitments. When we'll be doing the capital accounts in detail, we'll understand that capital commitments is like, say, for an example, uh, 10 million, three investor 30 million. Okay. But capital account balance could be could be different. Why? Because your fees, expenses, income, gains, loss, all these four attributes are directly charged to capital account. Okay. Your capital account could go high or could go down because of these four elements. Okay. But your capital contribution would be always same. The ratio would be 33.33%. uh, just for this sake of interest, let's not consider Mr. A. So your initial proportion of profit sharing, capital ratio, profit sharing ratio was 33.33%. So throughout the funds investing period, at the end of exit, at the end of the tenure, when exit will take place, when funds will be liquidated, at the time of distribution, only this 33.33% would be considered, not based on the ratio of capital accounts, because these, you know, elements are actually impacting your capital accounts. If there is an fees that will be charged to your capital accounts, so your capital accounts will go down. There is expenses, further capital account will go down. If there is an income, capital account will go up. If there is a gain, loss, urgl, unrealized gain and loss, or realized gain and loss. Everything will be charged to capital account. So capital account is just a accounting books of records, but your commitments is an legal binding between the fund and LP. So your profit sharing percentage will be calculated based on your capital commitment. Okay. Just I've mentioned like management fees will often be calculated based on the percentage of capital commitment. So we'll understand what is the significance of having an capital commitment ratio. What is the significance of this 33.33% ratio? Is it only the profit sharing ratio? No. The answer is no. Everything will be divided based on this ratio, your fees, expenses, income, gains, and everything. Okay, like in management fee will be divided based on that 33.33%. The prepaid quarterly or semi-annually based on percentage of capital commitments, and these are prepaid. Okay, now what does it mean by prepaid quarterly or semi-annually? Your fees or expenses, management fees and expenses would be charged as prepaid. Say your capital balance as 1424, capital account balance was 10 million. So on the very first day, fees and expenses will be charged. For an example, if it is 1 million, so your end of period, end of first quarter, capital account balance would be 9 million. For the sake of calculation, the ratio is 33.33%. Let's say total management fee would be 3 million for first quarter. First quarter. So 3 million into 33.33%, it comes nearly 1 million. So this 1 million would be charged. The significance of having this capital contribution ratio, capital commitment ratio, is spread wide enough, spread across the fund's tenure and all, and it is impacting all of your fees, expense, and all uh, elements. Clear? Now there's a new term, that is drawdowns. Since drawdowns of commitments are often done on a pro rata basis, there will be often be little difference between the ratio of an investor's capital commitment to total commitment and the ratio of investor capital account balance to the capital. So what are the terms we are finding here? Drawdowns. Drawdowns means nothing, drawing up the capital. Okay, you might find it a different jargon or some calculation part is there. No, drawdown means a simple, means how much should I ask for from the LPs. That is drawing down my agreement, drawing down my capital commitment and all that. That's it. Drawdown are Since drawdowns of commitments are often done on a pro rata basis, there will be often pro rata basis means what? Proportionate basis and quarterly basis. Okay, pro rata means proportion or periodically. Have you guys come across any item in partnership accounting like pro rata allotment, pro
Yeah,
rata
pro
allotment?
rata I have heard in the uh, share subscription. Like for if a company is launching a IPO, and if the IPO gets oversubscribed, then on a
Say
pro
for
rata.
an Yeah, at the same time, if there is some bonus issue. Okay, now bonus, in case of bonus issue as well, if pro rata means if someone is having 100 shares, they can issue on a pro rata basis that For every 100 share, 10 shares will be issued additionally. That is also could
The
be termed as pro rata. And what you have mentioned, that pro rata allotment in case of oversubscription, that is also correct. Pro rata means, you know, how much you have, you you you're not in a position, the fund is not in a position to allocate based on your subscription, but on a availability, based on your availability it would be distributed. So since drawdowns of commitments are often done on a pro rata basis, there will be often a little difference between the ratio of invested capital commitment to the total commitments. Total commitments means total commitments was 30 million. Now, on a pro rata basis, if you're charging all of your expenses, fees and expenses, in that case, your capital account would be impacted upward or downward. Now, if you add back your capital accounts, then it will certainly not match with your commitment amounts. And the difference would be sometimes it little or sometimes it is at moderate level. So there would be a difference between the ratio of an investor capital commitment to total commitments. The ratio of each one, each partner 10 by 30, 10 he has paid and total commitment, 10 is each partner's capital commitment and 30 is total capital commitment. So ideally it has to be, the ratio has to be 1 by 3. But because of this, when we'll be calculating everything, it could be like 1 divided by 3.1. Some little difference that would be there in the ratio. And similarly, the ratio of an investor's capital account balance to total capital. This capital account balance, if it has to be 1.1 by 3, after charging all these expenses, fees, and all elements, it could be like 1 by 3.3. Some difference would be there. So here comes an role of an accountant for reconciliation again. Okay. Investors are often subject to severe economic penalties if they do not satisfy their capital commitments when called upon to do so. Just in the previous slide, we have been discussing about legal obligations. There will be severe penalty if investor LPs are not, honoring those issue call notice. Okay, capital commitments call notice. If they are not obeying, if they are not honoring, so there will be some severe penalty as well. And consequently, this should be a rare occurrence for most fund. Why is it is mentioned that a fund which is charging its investor as a penalty for not honoring that capital commitments notice, that fund won't be recognized as a good fund. See, there is something called fi high. I think I have already mentioned financial highlights, or it is called MRP as well, management report on financial performance. In those notes, it would be mentioned that how much penalty is being charged and all that. Those notes are actually a statement to all the stakeholders. Now, a potential investor, consider this is an open-end fund. Next year, some investors are actually targeting this fund. If they see there is some huge penalties are getting charged each and every year for last several years, he might have an understanding that existing LPs are not dependable. So the fund's future is in question. So definitely he won't be, investing in those funds. Nobody would be interested to invest their money, hard-earned money, I would say, invest in those funds. So here it is mentioned that just a note I've mentioned that consequently this should be a rare occurrence for most of the funds.
My question is that the total commitment that all the LPs have made, uh, and generally, if a fund is calling that entire commitment in two, three, or four capital calls, but then there will always be a chance that one or two capital calls may get dishonored by one or two LPs.
It
So
is
in
not
that,
the case. There will not be always a chance. It's a rare chance.
okay, but then instead of that, why doesn't the fund call up the entire capital in one capital call itself?
It is. It could be based on the availability of money. It could be based on the performance of the fund. Okay, there would be some commitment from general partners as well. So there could be a clause that if this certain portion of profit is not been earned during the first year of the fund, then there will be a liquidation. Okay, so minimum IRR. If there is a fall of IRR, IRR is what? IRR, internal rate of return. Internal rate of return. This is the minimum return, the minimum percentage of return that a fund has to earn. Say for an example, if the fund is not performing in that level in the first or second, or maybe after the end of third year, even the IRR is not met. This is a financial break-even point. IRR means no profit, no loss. A kind of return where no profit as no loss is made. It is a break-even profit, break-even return. Even if the IRR is not made, then investors' money are going down. There is an erosion of capital. They're losing. Investors are losing their money. So there could be a clause in its agreement that if the IRR is not met in a particular year, there should be a chance of liquidation as well. There should be an open clause of liquidation as well. So in that case, LPs might discontinue with that fund. So that is why to keep in a safe side, LPs doesn't go in a kind of fund where all this capital would be, you know, commit all the capital commitments would be made in a first call in a single call.
Yeah.
It's just because of the protection of their money.
Because if the entire
Not
capital
much.
is called in one capital call, there is a chance that the internal rate of return will not be achieved.
If there is no internal rate of return is achieved, their fund will be locked for next 10 years. If there is no clause, no such exit clause or withdrawal clause is inserted in agreement, it's limited party agreement. Are getting my point or should I reiterate?
Yeah, I got it.
Okay.
I had one question with regards to
Yes,
the
yes, yes.
management fees.
Hmm.
So here it says the management fee will be considered will be calculated based on the percentage of capital commitment. So
Hmm.
usually the fund managers earn like huge money with the management fees, right? So usually it would be on the assets under management. So here it says it is calculated based on the capital commitment. So wouldn't that be a loss kind of situation for the fund managers?
For whom it going to be a loss?
In the sense, like if we had calculated it based on the asset under management instead of the capital commitment.
Asset under management concept doesn't even come in private equity.
Okay, all right.
AUM
Got
is a mutual fund term.
okay, all right. Then makes sense.
Yes. Okay. So next is distribution hierarchy. We are almost done with capital call. Okay. This is a basic sense. I think you guys have already gone through capital call sessions. Okay. Sivraj has already covered, right? In previous sessions. Anyway, the distribution hierarchy would start. Since the private equity funds underlying investment are liquid, especially early in the fund's life cycle, members are generally not permitted to withdraw their capital from the fund at any time. What do you mean by this term illiquid? See, A private equity fund takes time to generate return for its investors. When I'm mentioning return, I'm not talking about IRR. Internal rate of return it has to achieve at any cost. Okay. But to make the profit, once the internal rate of return is achieved, the balance is, if I just draw sorry, if I draw a graph,
So this internal rate of return is similar to that high watermark concept.
high watermark is a different thing. What I'm trying to say is, if this is the profit line and this is the revenue line, I mean here in this scale capital line, the internal rate of return, if it is here 12%, okay, anything beyond 12% is called MOS, margin of safety. After 12%, anything is profit. Okay, so every year the fund has to earn at least at 12%, or anything beyond 12% is a profit. Now, private equity funds generally are very illiquid in nature. It takes time. Uh, it is actually investing in long-term assets like real estate, in a company. That company is a distressed company or buyout or startup companies or expansion. So these companies will take time to generate profit, right? So in an initial stage, the investments, the asset classes are very illiquid. So initial stage, it is just an kind of stipulation upon the investors that they are not supposed to take back their invested capital. Okay, so there would be some lock-in period as well. Are you able to relate each and everything with anything? In the last slide, we have just discussed about why these capital calls are not been made in capital commitments are not been made in one call. At the same time, this slide we are saying, we are discussing that investors are not allowed to take back their money during the life cycle of a private equity fund because of its illiquid nature. Okay, now again these are conflicting. So this is a kind of locking period, locking situation for investors. So there is a constant negotiation goes on between investors and GP, that this should be the lock-in period. This lock-in period should not be beyond 3 years. Lock-in period should not be, and also GP says lock-in period should not be less than 5 years. I need the time. I need the money. I'll definitely fetch some return for you. It would be way more than your expectation and all that. So this is purely based on reputation and negotiation. Okay. In one hand, LP doesn't want their monies to be locked. That is why they do not pay the entire commitments in one call. At the same time, GP doesn't want seats to be liquidated or withdrawn money, that investor would withdrawn their money on a very initial stage, because illiquid funds will be, asset classes will be illiquid, so there won't be any return as per commitment. Okay, if the GP is not in a position to pay back the desired return as committed, then it would be a wrong reputation for him as well, and it will be a loss for him as well. Now the question could be, is GP is liable to those LPs of any committed return? See, letters, agreements doesn't form like this, that it's a guaranteed return of 20% or 30% or 50%. No GP would draw on a agreement like this. There won't be any guarantee. There would be always clause like it could vary between 20 to 30%. It is not a risk-free kind of investment. In risk-free kind of investment, if we go for a fixed deposits or government investments or bonds or fixed income funds, in that case, the income ratio is guaranteed and this much of rate of interest you would always get. The letters have been drawn in such a manner that a range is given. Okay, so it might vary to 13 to 26% or 20 to 30% like this. Clear? The next two point I mentioned that as various fund investments become marketable, the funds manager will begin to liquidate them and dis- discontinue the proceeds to the distribute the proceeds to the funds member. The distribution hierarchy, also known as waterfall, is specially defined by partnership agreement, but if generally follows the pattern described, what is means I've just described a generally followed pattern in the next slide. Okay. Now there could be four types of waterfall distribution. First level, second level, third level. First level is what? Investor receives a return of their invested capital plus expenses paid. Investor receives a return of their invested capital. So first level is what? First level, invested capital plus expenses paid. Second level is what? Investor receives a specified return on their invested capital, often known as preferred return or hurdle rate. At this level, the funds manager may receive a portion of its carried interest in the form of catch-up payment before any remaining funds are distributed. Carried interest is similar to a performance incentive allocation in a hedge fund. So in second level, what an investor is supposed to receive a specified return. Okay, here you have noticed that no return. In second level, what they are getting? Invested capital plus expense plus a specified return. Specified return. This is known as preferred return or hurdle rate. This is called preferred return or hurdle rate. Now, there could be a doubt that preferred return or hurdle rate, it is the minimum rate of return that funds has to fetch for their LPs. Now, does it similar to IRR? No, it has to be over and above IRR. It has to be over and above IRR. Okay. Now, in first level, you might have noticed GP's payout is nothing. GP is not getting anything in first level. GP's payout is zero. Here in second level, GP will get some return, some portion of profit that is called carried interest. Okay, carried interest.
Hi, Saurabh.
Sorry, I had to sip a bit of water.
Uh, Hi, Saurabh.
Yeah.
One question just I'm asking.
Mm,
At the first level which you showed, invested plus expense. So at least LP is getting some return, right?
no. At first level, no return in terms of profit. Investors receives a return of their invested capital. A portion of capital has been returned. Plus whatever expenses he has paid. In last slide, we have learned expenses has to be paid on a prepaid basis on a very beginning of the quarter.
Okay.
These two at first level investors are getting back. In second level, they are getting their cap portion of capital, their expenses, and little bit of return. That return is called as preferred return. That is called hurdle rate as well. At this level, funds manager may receive a portion of carried interest in the form of catch-up payment. This is also called catch-up payment.
Okay.
Carried interest or catch-up payment. Now, here I have mentioned may receive. It is not a hard and fast rule. Now, first, investment manager has to pay off all these capital, expense, and preferred interest to the LPs. Then, if anything is left over, out of that, GP can meet up its carried interest requirement. Out of that, GP will be paid the catch-up payment.
What I have a doubt regarding this preferred interest. What exactly is this amount?
Preferred interest means this is the kind of return at the second level. How does it happen? Is if you go through a typical letter, means agreement letter LPA, there will be mentioned at the very first the levels will be categorized. Okay, the return will be categorized into multiple levels, and it will be mentioned that in first level you are not going to get any profit. At a second level, you're going to get this preferred interest, and preferred interest rate might vary between in between this and this. Okay, maybe it could be just an over and above IRR. If the IRR is 10% or 12%, you'll get maximum 15%. That is a commitment that GP make. That your preferred interest, preferred return would vary between 12 to 13%. It's just a starting of profit. Means at the second level means what? The fund has reached at a certain level where fund has started generating profits for its investors.
So preferred interest does not mean that the LPs are
Preferred
not
interest
owners.
where I have mentioned preferred return.
Okay, it
Preferred
is not
interest
interest.
is different. No, interest it's purely related to any lending. This
Okay,
is not
okay.
interest. This is
So
preferred
prefer.
return.
Okay, fine.
Hurdle rate. I've mentioned hurdle rate. Yeah. This is hurdle. This is a hurdle. Means the fund, say for an example, if you are running a race, if you're running a race and this is the end point, there would be multiple hurdles. First, you have to achieve this hurdle, then this, after this, and this is the highest. Okay, this is the first hurdle rate, preferred return. Means the sense is like investor would say at least start returning us this much. This is the preferred return. If we find and it is okay, you are able to generate profit at least this much, then we'll make the another capital commitments. Then you raise the capital commitments call notice, then we'll obey that, will be honored, it will be honored after that. It is like this. You're getting the sense? Yes, no. What I'm asking you whether you are getting this
Yes,
sense or
sir.
not.
Yes, yes.
Yes, Saurabh,
What
got it.
your
Correct.
preferred return. Yes.
But then, just for clarification, I'm asking what is the exact difference between preferred return and profit?
What do you mean? Preferred return is a profit only. Preferred return is just like the sense should be that preferred by the word it suggests. Preferred means this much of profit after 3 years of running this fund business should come to us. The funds manager, the investors consensus is like that. At least you being a fund manager, return generate at least this much of return for us, then only we'll make further commitments, then only we'll make will honor your further capital calls. This is preferred return means preferred profit. You can term it like this: preferred, the baseline, the basic, maybe 15%. You show like an example, you show me that 15% you are able to achieve, then we'll believe you. First, the fund has to, everything is decided. Like at the third year of running, preferred return will be 15%. Once 15% is achieved at the end of third year, then further capital call commitments will be made. Okay.
So preferred return basically means that the fund manager is saying that the the profit before the next capital call will be that much.
At least this much he should
Okay.
earn.
And if the return from the investment before the second capital call is only equal to the IRR, then what does that mean? That the fund has only covered the costs of
Cost
raising the
of,
fund.
yeah, cost of capital has been earned, but no profit has been earned yet. Okay. Now it is based on the discretion of LPs, or based on the negotiation, or how does this partnership agreement supports. Investors may choose to opt out from the from the fund.
Okay.
Okay. So there is huge pressure on GPs. A GP is committing something, is he's taking a lot of ownerships. Clear?
Yeah.
So this is the first level. The second level where GP also starts earning few of its return. Okay, and this is called carried interest. It is similar to performance incentive allocation in hedge fund. Okay, in case of hedge fund, it is called performance incentive, and in case of private equity, it is called carried interest. Okay, so carried interest. One point to be remembered, that carried interest related to GP shall go tandem with preferred return or LP. This is a kind of pictogram you can draw. Okay. So preferred interest and carried interest. Preferred return and carried interest will go side by side. Correct? So, oh, my screen got stuck. Yes. The third level, the fund manager and its investor share the balance of process remaining, with the manager receiving its carried interest percentage. On third level, once the second level this maybe and second level has been achieved after third year, after next 3 years, the second third year would say, or at the end of okay, sixth year. Here, when the return is been earned, return sorry, my system is malfunctioning. When the return is earned, this return would be divided amongst LP and GP at a higher rate, at a higher rate than second level. Higher rate in terms of what? Carried interest. Means from third level, GP will start earning much more than the second level. LP would definitely ask, LP would definitely earn, but the growth rate of GP's return, growth rate of GP's return would start shooting up from third level. Clear? So once the third level is done, after all investment has been liquidated, there will be a liquidation phase will come at a fourth level when the fund will be liquidated. So final exit will take place. If a manager has received too much of carried interest, means GP has received too much of carried interest, some of it's refunded, some of it has to be refunded to the funds manager. Okay,
No, no.
funds
What is the
member,
difference
I would
between?
say.
Yeah.
Sorry, but I'm addressing your question. Let me complete this. Funds member. One, you know, have you guys heard about 80-20 rule? 80-20 rule. It's a common term in private equity. What does it mean? 80% of return would go to LP and 20% will flow to GP. If GP is earning too much, more than 80%, then it will be, distributed to LPs again. Clear? This is what I've tried to mention here.
But if the GP is also one of the investors in the fund,
Hmm.
then he
But
will receive the
GP's investment is 5% maximum, 1 to 5%, right?
so
LP's
GP whatever GP earns is basically a percentage of profit plus carried interest.
carried interest is a percentage of profit only.
No, no.
In
See,
first level, GP is not earning anything. Any percentage of profit is not been allocated to carried interest. I mean GP or LP. Okay. In second level, GP's carried interest percentage profit is very minimal. Third level, GP will be earning a lot. And in fourth level, if the accumulated earning of GP, accumulated carried interest, is very big, then some portion of that carried interest would be returned back to investors as well, members. And
So,
this term
Gaurav,
is called as clawback. Okay, this
yeah,
term is
one more.
called as clawback.
Yeah. Hi, Gaurav.
Yeah, yeah.
Uh, yeah. So it means in the case of carried interest, GP is earning more profit more than the catch up. In I mean that catch up level, because in the level of that carried interest, GP is earning too much of profit at this level, right?
At third level.
Yeah,
Or
yeah.
the third level, from third level it started shooting up, and fourth level it is earning too much. Means it is going beyond that 80-20 rule.
But at the
So
time of catch up level
yes,
also, but at the time
catch
of
up,
catch up
that
level also,
carried
GP,
interest is actually overriding catch up. It's much more than catch up. That is why the GP will return back some portion of profit to
so it
members.
means so it means we can say that in either in the catch up or either in the that carried interest. In both the cases, GP is earning the profit. In the catch up level or carried interest, in both the level, GP is earning the prof. I mean that that profit. In this case,
Yes.
yeah. Okay. Thank you.
Catch up level. What do you mean by catch up level and carried interest level? What are you trying to
Yeah,
make?
catch up in the catch up
Catch
level.
up is related to home GP,
Yes, yes, GP is earning the profit, no?
and carried interest is also similar.
Yeah,
See,
yeah,
both the term is similar. Carried interest and catch up in the
yeah.
form
That's
of
right.
cash. Yeah.
Yeah, but in the carried interest, more profit is earning in the carried interest. But catch up interest
No, no,
here.
nothing as such. Catch up is just a industrial term. It's an industry term of carried interest.
Okay. Yeah, sure. No, why I'm asking because na, as per the that waterfall distribution, the catch up level is coming under the third level. So that's why I just asked this question. I mean that I just that I just saw on the something on the Google or something on the YouTube when I was just giving the interview. So before interview, just I prepared like this on the first level what is coming, second level, third level, fourth level. So total we have the fourth level under the waterfall
Hmm.
distribution. So that's why so catch up level is coming under the third level, and carried interest it is coming under the fourth level. So that's why I asked this question. But now I got it.
Catch up and carried interest both are similar by its sense. Okay. Both are earning portion of profit for GP. Okay. Now catch up, provision catch up means it's a industry level term. Okay, catch up provision would be applicable and all that. When the fund has raised certain, has achieved attained a certain level of earning, that time catch up provision will be applicable. But otherwise, carried interest and catch up is both similar. And when there will be an excessive of return for GP, it is called clawback. The return of that portion of profit to LPs. That is called
Yeah, yeah.
clawback.
Follow back provision. Yeah.
Yes. Now, this is a simple point that in some cases, managers carried interest or a portion thereof will be held in an escrow account for the purpose of funding required clawbacks. Okay. Means if the if excess earned profit, if GP has earned some excess profit, which is way more than LP's shares, if he takes all those money back with him, so how LPs is going to recover? LPs are going to recover it from GP. So it has to be there. It has to be deposited in an escrow account, right? Then only once the legal consequences has come to an end, LP can take it back from GPs. That's it. Okay. So the next, I've just given an example. Assume that a private equity fund has three partners, including general partner. So two LP here, two LP, and one GP. Clear? Each of the two limited partners committed equal amounts of capital to the fund. The fund has 10% annual preferred return based on partners' invested capital, and the manager's carried interest rate is 20% with a catch-up provision. The manager liquidates one of the underlying investment of $15,000. 2 years ago, the investment was originally purchased for $10,000. The manager distributes the proceeds using waterfall calculation. At first level, proceeds was 10,000. Invested capital was 10,000. It's an inflow to the fund. LP1 has invested 5,000. LP2 has invested 5,000. Clear? Second level, preferred return would appear. This is calculation I have given based on the 10% of preferred return. How does it comes? 5,000 into 110% per year. 10% means if you are calculating at 10%, that is 10 by 100, it comes to 0.1. At the end of the first year, at year 1, previous 10% plus this year 0.1, it comes to 10.1%. That is 110%. 110%. Okay. So 5,000 into 110% into 110% for second year. This you have understood. 1 plus 0.1, it comes to 1.1. If you multiply it with 100, it comes to 110%. So this, based on this calculation, okay, minus 5,000 is the LP's return, and GP's return I have mentioned here. Sorry, this is GP's return per LP is the calculation for GP. Okay, process. This is the process. Sorry, let me break it down once again. This is the entire process. Okay, 2625. How does this 2625 has arrived? See this 80%, 80-20 rule I have mentioned. 80% for the second level. The preferred return, the total process is 2625, and each one is having this return like 1050, 1050. Okay, so if you add this 1050 times, it comes to 2100. 1050 plus 1050, and your profit was 2625. So if you do by deduct 2100 from 2625, it comes to 525. Okay, here the breakup is given. It's divided by 80% for the level 2 profits. The
Saurabh, can you
calculation, or should I reiterate this calculation, break it down for you? Sorry, yeah, go ahead.
I did not get for 2625 amount how it can for
Okay, I'll break
2625.
it down for you. 10,000 was the purchase amount. Okay, the sale of underlying fund is 15,000. Correct? You can unmute
Yes,
yourself. Okay.
yes,
The cost of investment was, the purchase price was 10,000. So 5,000 is the profit. Okay.
yes,
So out of 5,000 on year one, we had, I mean, on level one, level two. This is a calculation for level two. Okay. And for year one, Upon 5,000, LP1 is supposed to get 10%. 10% means, are you guys aware of this future value and present value?
Yeah,
Present
one
value
point R.
calculation and future value. If
Yes,
the
yes,
present value is 10 and it is growing, there is a growth of 10% each year. So at the end of each year, it will be 110%. Correct.
yes.
10.1 means 110%. So 5,000 into 110%.
Yeah, now I recall.
Okay. And why we are calculating year two? Here I have mentioned after 2 years it is when, see here I have mentioned each two partners and annual preferred return based on partners, you know, interest with the catch up rate. The liquidates one of its fund 2 years ago. 2 years ago, this investment was originally purchased at 10,000. Means this 10,000 was staying invested for 2 years. So 2 years profit these LPs are supposed to get, right? So 5,000 into 110% for year one, and again 5,000 into 110%. So it is just like a compound interest. Your money was invested for 2 years. First year, at the end of first year, you will be calculating again on that amount, another 110% will be calculated. So it is a compounding interest. Okay. So this is your total value of this 5,000 interest. Okay. So whatever it comes, okay, let me calculate you at 5,000 into 110% into 110%. It comes to 6050.
Yes, for me also. Yeah,
It is 6050.
yeah.
And your base profit was 5,000. That you have to subtract from here. So the balance is 1050 for each LP. That is why what here I have mentioned 1050 for each LP. Okay. Now for two LPs, 1050 and 1050 is coming together 2100. So I have mentioned that 80-20 rule. 80% is a payout for LPs and 20% is a payout for GP. Now, if the 80% payout is 2100, what would be the 100% payout? Total payout amount was what? 2100 divided by 80%. It comes to 2625. Okay. So total payout is 2625. Out of that, 80% is taken and divided amongst LP, and that is 2100, and a balance 525. This is attributable to GP. Clear? Akila, are you getting it?
I got it like 80%. I would want to see the calculation again after your record.
Okay, I'll just break it down once again. 80% you have understood, right? Now
Yes, yes.
80% is 2100. If something is 80% and it is 2100, what would be the 100% amount? We'll have to divide this
Yes.
2100 by 80%. That's it. That is 2625.
Yes, I got this.
Yes,
I was
just
also doing calculation, so
mm,
Why not we calculate directly 20% on 2625? I mean 2100.
first you'll have to pay for LPs, right? Then only GPs are entitled to get any profit. So that is why we follow the similar approach. We calculate for LPs first, then we followed by GP. Okay.
Mm.
So this level is clear. Now third level, carried interest level. Again the similar, here I have given the breakout. The at third level, the LPs receive 80% and the GP receive 20% of the remaining proceeds. Remaining process is what? 5,000 was the total proceeds. At the first level, 2625 has been received. It's been distributed amongst LPs and GPs. The remaining is 2375. Out of this 2375, 80% would be distributed equally amongst LPs. That is into 80% by 2. So 950 per LP, and remaining portion would be for GP. Okay. Now here, as because it is up to 20%, no excess amount is been received by the GP, so no clawback is there. Had it been the case, any excess amount has been received by the GP, then there would be a clawback. Okay. So if you total it, that your total process were 15,000. Out of 15,000, 80% is attributable to LP. So if we calculate 15,000 into 80%, it comes to how much?
12,000.
12,000. 12,000 and 15,000 into 20%. How much? 3,000.
3000.
But as per this calculation, it is not the amount. LP has received 7,000. Each LP has received 7,000 and GP has received only 1,000 only. Then how come this 80-20 rule applies? This is why I'm saying this 80-20 rule doesn't apply from the very beginning. Okay, in a first level, there is no profit, no sharing of profit. See, in a first level, only capital is been distributed and returned to these LPs, and GP's here is nil. From here, the second level, this distribution of profit has started. So it is like this. 80-20 rule applies from level 2. I think now you got the sense.
Yes, we got this. I had one more question regarding these levels of payment or levels, basically. So,
Mhm.
say, as in this example itself, so they have liquidated one of the investments for $15,000 after 2 years. So, in this case, when would the first level would be paid out? The profits would be paid out to the investors, and is there any specific intervals of time, or how was it?
It is purely based on the limited party agreement that GP and LP is having amongst themselves.
All right. So in for example, say there is an IPO. They had invested in a company and that did sorry, 1 second. Sorry for that. Yes. So for example, they had invested in a company and that went into an IPO. So in this case also, so they will follow all these levels of hierarchy in the for the distribution, is it?
Obviously.
Oh,
You
thank
mean
you.
your question is if there is an issue of IPO, if there is an initial
Yes, so
public
they
offering.
would get the proceeds only at the end of the,
Yes, yes.
subscription or something.
Yes,
So
yes,
would they
yes.
follow all this? Yes,
Say
thank you.
just term it like this. This IPO has been published, and the shares cost was 10,000, and it has been sold. The IPOs are sold at 15,000. So this is the distribution, waterfall distribution model will be applicable.
All right. So that proceeds will be again distributed in this hierarchy. So that is what
Correct,
that's the
correct,
point.
correct,
Thank
correct, correct. There could be multiple types of distribution level. This is just a simple example. In next session, we'll be showing that some real-time examples of distribution level, distribution, waterfall distribution models. There are so many critical types of distribution model. This level one, level two, level three, level four is just a beginner's level. If you want to understand what is waterfall distribution, this is an appropriate example. Otherwise, there are multiple types of distribution. Those are very critical. Probably next Saturday, we'll be conducting a session on live examples of calculation of waterfall distributions. Okay. So for the interest of time, we'll move further. Now, these are few journal entries are posted here. How to record a cash distribution to partners. Okay. So distribution to partners capital to cash distribution. So once you being an accountant, you have to know the journal entries, right? So this previous one was calculation. This is a distribution to LPs. Now 1050 and together this 7,000 and 7,000. How you are going to journalize this entry? This is distribution to partners capital. So in the books of funds, in the books of when you being an accountant, you are preparing partners capital. You've been an accountant appointed for a private equity fund, and you are preparing a partner's capital account on behalf of those LPs. You will be debiting distribution to partners capital and crediting cash account, cash distributed. Okay. Why is it so? See, this partner's capital 5,000 has been paid off to partners. Correct. So partners capital account will go down. If initially partner's capital was 1 lakh, during this process, each LP1 and LP2 got 5,000 of their capital back. Correct. So once the partner's capital account is getting reduced, means initially you have taken those capitals from partners. Now you're paying back to those partners. So when you took those capitals, so your account entry was cash account debit to partners capital account credit. Okay. Now the reverse is happening. You are paying back those capitals. So obviously partners capital account would be debited and cash will be what you are paying back, your cash. Cash is going out from your bank statement. So it will be cash will be credited and partners account will be debited. Partners capital account would be debited. Now tell me, partners capital account in the books of fund is a liability or an asset?
It is a liability because uh, the fund owes it to the owners of the fund.
Ultimately, the funds are liable to pay it back to partners.
So, so basically, it is the equity of the fund,
Yes.
and equity is the liability of a of any entity towards its owners, and liabilities are something that the entity owes to parties other than the owners.
Capital is a liability for a fund. Okay. This comes the entity concept. Your fund and your business and you are two separate entity. Just think like this, your business is borrowing some amount by way of capital from you. Okay. You are the investor and your business is the borrower. So for from just think from business your business perspective, he is when an entity, at the end of the tenure, he is supposed to pay back whatever capital you have invested. He has borrowed it from you. This is the case. So at the time of investing a capital, cash was when flowed in. There was an inflow of cash. That is why cash was debited asset, and there is a generation of liability. Liability has arisen. by way of capital, that you have to pay it back at the end of the tenure. That is why once the fund is the process is getting liquidated, the cash you are paying back and capital what you had to pay in other case, in the first instance when capital was liability for you, thus no longer these 10,000 would remain as a liability in your books of accounts. Okay. So some funds may elect to retain the distribution amount to reinvest in other investment or to pay expenses. This procedure is referred as a deemed capital call or distribution. Okay. Deemed capital call when it happens when distributable amount is not been distributed to LPs. But in the very first, I think second or third slide, we have discussed that in case of private equity, there is no reinvestment of distribution. Here, it is not getting reinvested, rather, it is getting back, it is adding back to your capital call. If you are supposed to pay the third capital call without paying the third capital call, you can just ask your GP to adjust your payables and receivables. You're about to receive this distribution, you can adjust with my next capital call. This is it. In this case, the amount retained by the funds usually reduces their partners' remaining capital commitments. That is what I've just explained. Clear? No doubt in this point? Okay. This is what overall idea on distribution. Now, funds investment. The investment made by a private equity fund are normally determined by the fund's investment committee. There is one fund investment committee has been formed in a private equity, which may consist of employees of the advisor, general partners, and directors. The investment committee meets periodically. This is a normal thing for knowledge purpose. Interview questions may ask, may not be asked, but you never know what kind of questions it is waiting for you. The investment committee meets periodically to determine which investment to make and whether to call in capital to fund this investment or not. Investment made by a private equity fund are usually valid at cost unless an event occurs that would indicate a different value should be used. Normally, investment made by a private equity fund are usually valued at cost. Okay, unless there is an other scenario. These events may consist of following. This unless there is different events. What are the events? There is subsequent round of financing for a company in which the fund is invested that would indicate a different value for the investment. An underlying company issues new financial statements and industry reports indicates that a new value should be used. The underlying company has another class of equity that trades on an exchange and that class changes in value. If the private equity fund invests in other funds, these funds' financial statements may indicate that income, realized or unrealized, should be recognized. I would just give you 2 3 minutes. You just go through this page one by one line and we'll discuss after that. 1 second. So, anyone wants to brief us? Any idea you've got from here?
Yes, I
Yeah, tell
participate
me.
in points. So it says that whatever investments the private equity fund has made, that is usually valued at cost, unless there are few instances like mentioned below. So one of the instances could be, say the underlying company has raised another round of investments from somewhere else. So that will change the value of the company. So in that case, we need to integrate the new value of that
Yes.
investment. That is one. And if there is any underlying company issues new financial statements, or there is industry reports that indicates a new value. So there is some trend in the industry which says that, it might be some sort of
Mhm.
appreciation, or something is trending in, or something is happening in that respective industry, so that value is increased. So in that case, we would value it at different other than the cost.
Mhm.
The last 2 points I had question, like it mentions that underlying company has another class of equity. So what do we mean by the other class of equity? And that is traded on exchange. So usually we invest in companies which are unlisted. The
Mhm.
private equity would usually invest in unlisted companies. That is one question I had.
Mhm.
And apart from that, the last point I had was, if the private equity invest in other funds. So it means in another private equity fund if they invest. Is that what it means to say? So I had these two.
Okay, let's start with the very beginning. Cost. What do you mean by cost? If you are purchasing something at rupees 10, that is your cost.
Right,
Correct. Now, if you are investing in a security or a private equity, private companies equity, whatever amount you are paying, that is your cost. Okay. Now, let's begin with the second last point. The underlying company has another class of equity. The one just you have mentioned in last example, IPO. Those unlisted securities are getting listed. Now, IPO, once it is listed, the price will change, right?
right,
Now, even if that time, if the private equity firm wants to continue to stay as an investor, in that case, its cost will be changed. Its cost will be based on the traded price at
right.
an
Got it.
stock exchange,
Yes, as for the stock exchange market.
as per the stock. Clear? Okay, that's last point. If the private equity fund, others, are you guys clear with the second last point? What could be the scenario, or should I reiterate? Okay, I'll just repeat once again. Private equity firms normally invest in private firms, means private companies, which are unlisted shares. In this case, if the unlisted shares are getting listed by issuing an IPO, and even after the issuance, if the private equity fund wants to continue as an investor, wants to stay invested even after listing of those unlisted equities, in that case, the traded price would be the cost price of those investments. Clear? The third point is, if the private equity fund invests in other funds, means in a financial, if in for fund of fund, and those fund of fund has made any changes, has made any adjustment, any fair value adjustment, or m to m, mark to mark adjustment on their derivatives and all that. Okay, in that case, whatever investment value is been showed in that financial statement, so that would be the cost price for those private equity funds. Clear? At the beginning of the year, maybe the investment price was 100 million. At the subsequent date, at the end of the year, when that fund of fund has released its financial statement, those investment values has moved either up or down. So the prevalent market price of those investment would be the cost price for that top fund, top private equity fund. Okay.
Yes, that clears my doubt.
Anyone else? See, the first and third point is similar to each other. In third point, it is actually an underlying fund, and in the first point, it is an underlying company issues news financial statement. Means the private company in which that private equity has previously invested, That private company is changing his value, is share unlisted equities market price. Okay, by book building process or by revaluation of shares or anything, they have brought in new capital. There is question of merger and acquisition, there some expansion or something. So by means of anything, that per unit equity price has been moved up or down of that private company. In that case, the cost price has to be revalued, right? This is the thing. Anyone else having any doubt? Sagar's well. Mahesh, you are very silent. Why is it so?
Yeah, all good from my side.
Okay.
Yes, yes, understood.
Shali,
Yes, all good.
yeah, are you getting? You're so silent. Actually, this is the first time I think you are attending my sessions, right? Or yesterday you were there.
No, yesterday I was not there. But before you have taken two sessions, I guess I was there in that sessions.
Okay.
Yeah.
Okay, sounds good. So let's. Okay, today's class will be a bit of extensive class. Okay. So please be patient till 7 p.m. at least. So this fund investment journal entry, you can take it down now. When the value of an underlying investment is changed, an entry to record the change will be entered on a fund's books. Like an entry to a record, a positive change. If there is a positive change, then it will be adjust carry value up, and it is an asset account debit to unrealized gain. Why unrealized gain? If any investment value is getting up, means initially your investment value is getting, if it is getting increased, means initially your investment value was 100, now it is 110, but you have not sold out those investment, but there is a profit that is not yet realized. That is why it is called unrealized profit. So profit, where do we charge? I, if it is a profit, then we charge to the credit side of the P&L account. In case of fund, it is SCI. On the credit side of SCI, statement of comprehensive income. If there is a loss, then we charge it to the debit side of P&L. Okay, and in both cases, adjusted carry value. If there is a positive change, then it will go up. Your investment value is going up, means asset will be increased. When the asset is increased, it is always debited. So asset account adjust carry value up, asset account debit to unrealized gain. And if there is a negative, then completely opposite, unrealized loss account debit to adjust carry value down. Clear? See, here mentioned that adjust carry value up and down is similar to unrealized appreciation or depreciation of a security or investment. Clear? Shall I move to next slide?
Yes, yes. Let's proceed.
Yes,
Okay. If a private equity fund invest in other private equity funds, that's the second scenario, the FOF. It would be required to respond to capital calls made by the underlying funds to the extent of its commitments. Means top fund, like yesterday we have discussed at Blackstone and all, we have discussed a lot. Say for an example, Blackstone is the top fund and underlying fund is Kedara Capital. Okay, so Blackstone is supposed to make some capital contribution, being a top fund, to the underlying fund, that is Kedara Capital. Now Kedara Capital has issued call notice. So when cash is disbursed for an underlying fund, the following entry has to be made. That purchase cash account debit to cash disbursed. This is a typical entry where both cash account has been debited and credited. Purchase cash asset and cash disbursed. Clear? At this time, the private equity fund would reduce its unfunded commitment to the underlying fund by the amount of the capital call.
Sort of for cash disbursed, just cash out, right?
cash out. Yes.
outflow of the cash.
Yes, yes,
Yeah,
yes.
yeah, okay, okay, fine.
This line I think quite clear. At the, at this time, the private equity fund would reduce its unfunded commitment to the underlying fund by the amount of the called capital. Means Blackstone being a top fund, it had some amount of unfunded capital. Now, since it is paying its capital to its underlying fund, so its unfunded capital amount will get reduced. Clear? The next one,
Okay.
when distributions are made by an underlying fund, distributions are made by an underlying fund means the FOF, the underlying fund, bottom fund, top fund and bottom fund, underlying fund, for industry jargon we call it bottom fund. If the bottom fund is making any distribution back to the private equity fund, that is the top fund, the following entry has to be recorded for the amount distribution. That is cash received to return of capital account. Cash received means where you are entering, recording these entries in a top funds account in the books of top fund. It's cash received account. Distribution received means cash by way of cash or bank. I mean, by whatever means it has been received. So that amount will be debited, cash received, and return of capital, ROC, return of capital account would be credited. If this distribution may be recalled by the underlying fund at some point of time in future, the credit would be return of capital, recallable, and the amount of the private equity fund's remaining commitment is increased at this time. Means if it is a callable distribution, means now the underlying fund is paying back to top fund, but in future whatever distribution is paid, that could be called back as a capital commitment as a next call. If that is the nature of distribution, in that case, instead of return of capital, it, the ledger name should be return of capital recallable. Clear? Return of capital recallable. And the amount of the private equity funds remaining commitment means top funds remaining commitment, an unfunded amount is increased at this time. Okay. So as because the top fund is not sure whether after 6 months this amount would be taken back or not. So, for the safer side, that unfunded amount, top funds keeps as it is or increase by this amount. Clear? Any doubt in this point?
Saurabh, for this entry would be, that at the time of redeemable for the cash received account debit to return of capital asset account.
If it is not
Yes.
redeemable, then
Yeah.
top fund would directly pass on this entry. If it is a redeemable, means top fund is not sure whether after 6 months this amount has to be returned back to underlying fund. In that case, if it is not sure, in that case, only cash account received will be as it is. There will be no change in the first line. In second line, it will be return of capital redeemable. Okay,
Yeah.
I mean recallable, not
Yes.
redeemable, recallable. Means it will be called in future. It could be called in future. It's callable. In money market instrument, we have understood the callable variable natures of financial instrument, debt instrument, callable bond, variable bond, floating rate bond. Okay,
Yes.
callable we have discussed, right? The same similar logic applies here as well. Also, if the underlying fund is returning unused capital, if the underlying fund is returning back the unused capital, the credit would be to return of excess and amount of the private equity funds remaining commitment is increased at this time. Means if there is some amount which is, say for an example, the underlying fund, that is the bottom fund, has not invested the entire capital. There is some portion of capital is uninvested and is showing by way of cash. Okay, this is uninvested capital. The amount is not invested. In that case, if the underlying fund is announcing some distribution and paying some distribution, in that case also the first line cash received in top fund would be same unaltered. This would be this the second line would be return of excess. The ledger name would be return of excess. This is the normal scenario. This is the second scenario where there could be callable. So return of capital, recallable, and this is the third scenario where underlying fund has not yet invested the entire capital. Some portion of capital is lying, still lying uninvested here. Okay. The next one is just one sec. So at the time of distribution, an accountant needs to determine if all or part of the distribution requires the recognition of realized income and a corresponding change in unrealized appreciation depreciation or not. If such is the case, the following entry will have to make. Now, on the first line, you'll have to understand the scenario. In first line, I tried to explain the scenario. At the time of distribution, an accountant needs to determine if all or part of the distribution, if the distribution is 100, the entire 100 or any part, let's say 50, distribution requires the recognition of realized income or not. If it is if it is requiring a recognition of realized income, then corresponding changes has to be made in unrealized appreciation and depreciation as well. Let me break it down. Unrealized gain and loss. What is this? It is the difference between your investment's fair value minus cost price. You had 100 rupees of your initial investment in a security, let's say security A. You bought this security at a rate of 100. Now, after 1 year, it is 120. So, there is an appreciation of 20, correct? Now, that is unrealized. Unrealized gain. Why unrealized? You haven't yet sold out this security. There is only an changes. Say for an example, these securities are tradable securities. It is getting traded in a recognized stock exchange, and the share price has increased from 100 to 20. But still, you haven't sold it, so these are not realized. Means the cash is not been realized, and it is not there in your account, bank account. So this 20 rupees uh, appreciation, this gain is an appreciation in your unrealized gain. Say previous year, year one, you had 26 as the balance of unrealized gain and loss. This year, at the end of year two, another 20 is an appreciation. So at the end of year two, your balance of unrealized gain and loss is 46. Correct? Now, on a third year, for an example, if it is like initially it was 100, now if it is third year, if it is again 86, and it was 100, then there is a decline of investment value and it comes to 14. It is negative, so it is an depreciation. First year it was an appreciation and this year it is depreciation. Then again you have to add this back to your unrealized gain and loss journal. So this time it will be subtracted from 46, so it comes to 32. This is what here it has been mentioned, that accountant needs to determine if all, means if the entire distribution, now come to one point that your underlying fund or any investment that you have made, that is been distributed to a top fund or the private equity or to LP and everything. Let's take it fund of fund example, that it will be easier to understand. If the underlying fund is distributing something and you've been an accountant, you are accounting from top for top fund, then you'll have to decide whether 100 out of 100 is a realized one or not. Means the distribution is being made by the FOF, means underlying fund, just because of change in the fair value of securities. The previous fair value was maybe 120. Now the current fair value is 180. Now this is an 60 rupees unrealized gain. Now you being an accountant, you have to see, since it is an unrealized gain, so previous unrealized ledger balance, whatever I had, whatever you had, you have to add it back. Means there is this appreciated amount you have to add back, means further you have to add it to that ledger account, unrealized gain ledger account. In the opposite case, had it been gone down, if there is an depreciation of 20, in that case also you had to depreciate your existing unrealized gain loss balance by 20. If there is a case that the FOF has sold out this process, the security A, the FOF has sold out, means the underlying fund has sold out at a price of 180. The previous fair value of the security price was 120. Hope you would understand on that time. So there is an realized gain, correct? So this realized gain has to be added back to realized journal. There's an appreciation. There's an appreciation. There would be an appreciation of ledger balance of realized gain. So you'll have to add it back to realized gain. On either case, if there is a loss of 60 or any amount, so let's say 40, then you have to depreciate or subtract from the uh, realized gain ledger account. So what would be the journal entry for this? Like this, cash received. If there is an gain, then cash received. I mean, in all cases, if there is an distribution and cash has been received for that, so you'll have to debit the cash account and credit the capital gain. And consequently, based on the nature, if it is unrealized or based on realized, so you'll have to adjust in this part. Unrealized gain loss, debit, and carried adjust carry value up and down, asset account credit. Why carry value up and down of asset account? It is the value of investment. And this all story is getting summed up here in unrealized. Clear? Any doubt on this?
Yeah, it's okay. Thank
Okay. So the last part is fees and expenses. Okay. So upon entry to a private equity fund, investor may be required to pay placement fees. Okay. These are typically 1% to 2% of the commitment amount and are paid in a transaction outside the fund. Management fees are paid to a fund's advisor or general partner on an ongoing basis for service provided to the fund. These fees are 1% to 2.5%. So management fees should lie between 1% to 2.5%, and placement fee is a 1% to 2%. Now placement fee is outside the fund expenses and management fee is related to funds. Okay. So 1 to 2.5% amount of committed capital on an annual basis until the commitment period expires. On every year, the LPs has to pay this much of amount. So if the committed capital is 30 million, so 1% or any percent between 1 to 2.5%, this LP has to pay to this GP. After the commitment period expires, the fee may be based on the net invested capital. Okay, after the commitment period expires, the fee may be based on the net invested capital. What does it mean? Now, if the fund tenure is 10 year and all those commitments, capital commitments are when honored by the LPs at the end of sixth year, okay, there won't be any further charge upon the capital commitment. In that case, this percentage will be charged on invested capital. So once all the commitments have been honored, so there is no unfunded capital, so it will be converted into invested capital. So you'll have to apply these percentages directly on the invested capital. These fees are generally prepaid quarterly or semi-annually. So initially, we said management fee would be paid on the committed capital commitment period on an annual basis, on a prepaid basis. Okay. And once the capital commitment time is over, management fee will have to pay based on invested capital. And that time you can pay, the LP can pay quarterly or semi-annually. Clear?
Saurabh, one more thing. Placement fee will be calculated on total commitment amount,
No,
as
it is
the fund is
outside fund. It is outside fund. It is has to be paid upfront. There is
up.
nothing to do with committed capitals.
Yeah, yeah, that is the upfront fee. I mean that initially whatever that that subscribe amount. Okay,
But
either
there is no rule of placement fee. It could be 1% or 2% of the committed amount. Okay.
okay.
But so what is your question?
My
Outs
question is, I mean that as you mentioned here, 1 to 2% of the commitment amount and are paid in the transactions. Okay. So what I'm trying to understand, I mean that what do you mean by that outside of the fund? I mean that investor, if investor commitment is like 1 crore, let us example. So initially that fund manager will be calculate whole that placement fee, that upfront fee on total commitment that on the 1 crore.
are paid in transaction outside the fund means it won't be counted as a funds transaction. This is something the LPs has to pay from their pocket, placement fee.
So it means
It will not be returned back. Now in distribution we have understood in first level capital and expenses are getting returned at the first level, right? So this placement fee won't be returned back. Management fee could be returned back, but placement fee not.
So is it related to unfunded amount? We can say that.
No, no, no. This is something you are paying from your pocket.
Okay.
Okay, I being a GP, I'm saying that your capital commitment will be 1 crore out of 1 crore. So apply 2% rate. That would be placement fee that he will be paying me, paying to the fund, but it will not be returned to you.
Okay. So just I'm asking one more question. Suppose in the loan syndication process, okay. Suppose in the loan syndication process, borrower has to subscribe that 1 crore. Let us example. Okay. So out of the 1 crore, but he utilized only for 60 crore. Okay. But I mean that for the funded amount for the 60 crore, and out of the remaining amount, that 40 crore will be go through the I mean that unfunded amount. So upfront fee, I mean that in that case, upfront fee will be calculate on 1 crore, that could that that total
One
commitment
crore, 1 crore.
1 crore. That's the mark. Okay, okay. Thank you.
No problem. See, for any expenses, if the journal entries are normal. You'll have to person due accrual entry, that is expenses, legal fees, expense, account debit to accrual legal fees, expenses. And when you will be paying that amount, then you'll have to nullify the accrual entry by debiting accrual legal fees and by creating cash disbursed. Anybody having doubt in this kind of entries? This is a normal simple journal entry, payment entry. You have to create a due entry,
Yes,
okay,
yes, we are good.
and then cash entry.
Cash sheet and the approval sheet. Okay.
Yes, clear. Now, mm, just a kind of this entry is required to an accountant maintain in detailed record for those expenses that were paid in cash versus accrued expenses, and cash payment must be analyzed to determine what accrual period they pertain to, and accrual amount the cash replaces. Okay, so what it is referring is, it is referring the period, the closing entry, accrual entry will have to pass for the particular period, and consequently the closing entry, the cash entry also has to be posted related to that period only. Even if you are paying it in a later date, what you are doing it, once accrual is created and it is not been paid within that period, you are passing an outstanding entry. Okay, like initially it was like accrual entries you have passed, those accrual entries, management fees, account debit to accrual of management fees. Now, at the end of the quarter, you are supposed to pay it back. Means you will be debiting accrual and crediting cash, but instead of that, you're not paying it. So, in that case, what you can do, this accrual entry you can transfer to outstanding. Means accrual account debit to outstanding credit. Now, once you will be paying that, again you will be debiting outstanding and crediting cash. Clear?
Yeah, yeah. Cleared. One more thing I want to ask. If the
Yes.
if the investor will pay the management fee on the same day, I mean that either in cash or either in the bank account, so no need to keep it in the accrual entry on that day.
Always you'll have to create a accrual entry because we are following accrual concept of accounting.
But if
Even if I know the Sohail is waiting with cash, so as per the prudence concept, I'll just pay. I will show in my books of accounts that I'm supposed to receive something from Sohail. Now I'm debiting cash as because Swell is paid it. First, I will pass the receive accrual entry. Like I will create a dater in name of Swell. Okay. After once the cash is received, I'll nullify the debtor. First, swell account debit to accrual, uh, then cash account debit to swell. Okay.
Got it.
Means cash account debit to accrual of swell. Okay.
So it means approval bucket is important before going to the cash bucket.
Exactly. So here I've just given some example that 10,000 of legal expenses was accrued for 3 months period and a cash payment representing the legal expense for the same period of 8,000 was subsequently made. The following entries are accrual legal entries 10,000, cash payment 8,000 and expense legal fee expense is 2,000. Just a bifurcation of the 10,000. 10,000 is the accrual legal fees and cash was paid 8,000 and balance 2,000 legal fees is been is it is just like an outstanding fee. This is here outstanding. I have journal entries right now. I should have written his outstanding expenses. This is just an outstanding expense. This is out of 10,000, 8,000 paid in cash and 2,000 is been transferred as outstanding. This entry result 2,000 decrease 8,000 cash. It's in total expense. That is it. So this is the thing. So now I think a lot of questions answer we have already done. If anything you want to discuss, I'll just stop the recording